Welcome. Here we'll discuss the opposite side of purchases, that being sales. This presentation covers sales of merchandise under the gross method. If your course teaches the net method, please make use of my other video on the subject. We're also going to work with some new accounts. Back to Ride and Fly bicycles. We're still going to deal with our merchandise inventory account, but we'll also utilize our sales of merchandise, sales discounts, and cost of goods sold. Please note that cost of goods sold is sometimes referred to as cost of merchandise sold. Let's do a quick review. Remember our basic journal entries for acquiring merchandise. We debited merchandise inventory for an increase in assets, and we credited cash for the decrease in our cash asset. In the case of a credit purchase, it's the same entry, save we credit accounts payable for the increase in the obligation to pay. So that's what we book when we acquire merchandise inventory. What do we record when we sell that inventory? Imagine R&F Bicycles sold $100 of merchandise for $200 in cash. We can start with the obvious. We know we're receiving $200 in cash, so we'll debit our cash account for that amount. This debit will be an increase to our assets. We acquire this cash by providing a good to our customer. This provision entitles us to payment. In other words, we earned it. Whenever we earn money, we record a revenue. This credit to our revenue increases our equity. Remember our definition of a revenue. It's an inflow of equity that increases our assets. The second part of this transaction focuses on merchandise inventory. We earn this money by transferring ownership of the merchandise to the customer. Since that merchandise inventory is no longer ours, we need to remove it from our books. If we put merchandise inventory on the books with a debit, we'll take it off the books with a credit. We paid $100 to acquire this merchandise, so that's the amount of our credit. What about our debit? We acquired this merchandise for the express purpose of selling it. So by selling it, we've effectively consumed it. Whenever we consume or use an asset, we debit an expense. In this case, cost of goods sold. Whereas revenues are an increase in equity via credit, expenses are decreases in equity via a debit. Here we see our definition of an expense exemplified. It's an outflow in equity via the consumption or use of an asset. Every time we sell merchandise inventory, we're going to book these two journal entries. First, we'll increase our asset by crediting a revenue. Secondly, we'll remove merchandise inventory from the books by debiting an expense. What if R&F sells $400 of merchandise on account? That merchandise originally cost R&F $200. Remember, on account means this is a credit sale. These journal entries will be nigh identical to our previous one, except we'll debit accounts receivable instead of cash. The journal entry's impact on our accounting equation will also be the same increases and decreases to our assets and equity as with the previous entry. The $400 sales price is our debit to AR and our credit to sales, and the $200 cost is our debit to CGS and credit to merchandise inventory. When the buyer pays in the near future, the seller will credit AR off the books and debit cash collected. Just like with purchases, any early payment discounts will impact the amounts booked in our journal entries. The good news, these terms mean the exact same thing to the seller as they do to the buyer. Under the credit terms 210 net 30, the seller is offering a 2% discount off the gross purchase price if it receives payment within the first 10 days after the invoice date. If not, the buyer must pay the full gross amount within 30 days. Imagine R&F sells $400 of merchandise on account, terms 210 net 30. The cost of the merchandise was $200. Under the gross method, we book the sale at its gross amount. In other words, book this entry as we've done in the previous examples. Debit AR and credit sales for $400, and debit CGS and credit merchandise inventory for $200. The discount is only reflected when the buyer pays within the 10-day discount period. In this scenario, we will credit AR off the books for the full $400 and will debit cash. The issue is how much cash is being collected. R&F won't get the full $400 because of the discount. Rather, it'll receive $400, the gross price, reduced by the 2% discount to yield $392. That's the amount of cash being collected. You could also calculate this amount by multiplying the $400 gross price by 1 less the discount percentage. In either case, the cash to be received is still $392. Now our entry is out of balance. It needs an $8 debit, which we'll put to sales discounts. Sales discounts is a contra revenue account. This means that it's tied to our other revenue accounts, specifically sales of merchandise. But whereas our revenue accounts carry a credit balance, as a contra account, sales discounts carries a debit balance. Consequently, when we build our income statement, the credit balance in sales will net against the debit balance in sales discounts and give us net sales. Imagine R&F sells $600 of merchandise on account, terms 210 net 30, and the cost of this merchandise was $300. If you like, pause this video and see if you can book both the journal entry for the sale and the payment within the discount period. We book the sale as follows: debit AR and credit sales for $600, debit CGS and credit merchandise inventory for the cost of $300. When the buyer pays within the discount period, credit the $600 of AR off the books and debit cash. Since the buyer is paying within the first 10 days, the cash collected is not the full $600, but 98% of that amount, or $588. You could also determine that amount by taking the $600 gross price and reducing it by 2%. The needed $12 debit to balance our equation goes to sales discounts. The sales discount debit is necessary to keep the company's accounting equation balanced. With the first entry, the debit to AR increases the assets, and the credit to sales increases our equity. I've already covered how the second entry expenses merchandise off the books. With that last entry, the debit to cash and credit to AR increases and decreases our assets. These two by themselves unbalance our equation. The debit to sales discount decreases equity so that the total cash received matches the total net sales booked. What if the customer doesn't pay until after the first 10 days of the invoice date? In such an instance, the entry for the collection is even easier. Again, credit AR off the books, and the full $600 will be paid in cash. Let's consider partial payments on both sides of that discount period. In this case, RNF sells $800 of merchandise inventory, costing $400, on account, terms 210 net 30. We'll book our two-part sales entries as usual. Debit AR and credit sales for $800, and debit CGS and credit merchandise inventory for $400. So as of this sale, the customer owes $800. What if the customer pays $500 of the amount owed within the first 10 days and then pays the remaining balance afterwards? With the first payment, we credit AR for $500 and debit cash. But $500 won't be the amount of cash received. Since this payment is coming within the discount period, we only receive 98% of that $500 amount, or $490. That last debit to balance our entry will go to sales discounts. What gets recorded when the balance due is satisfied after that discount period? After that last payment, the customer now owes $300. To collect that amount, credit AR off the books and debit cash for what we receive. Let's review shipping terms. We still deal with the same shipping terms as discussed in the previous lecture. If that information is still fresh in your memory, you may skip ahead. If not, hang out for a bit while I retread this ground. When you're selling a physical good, it has to be delivered to the customer. Which party pays for the delivery impacts how it is recorded. Our two basic shipping terms are FOB destination and FOB shipping point. With FOB destination, the buyer doesn't legally own the merchandise until it arrives at his or her destination. Since the seller still owns the merchandise when it's loaded on the truck, the seller must pay for the delivery. Once it arrives at the customer's location, the buyer signs for the delivery, taking legal ownership at the same time he or she takes possession. When the selling company pays for delivery, it records it as an expense. In other words, it'll debit something like delivery expense and credit cash. With FOB shipping point, the buyer legally owns the merchandise inventory as soon as it's loaded on the truck for delivery, or at the shipping point. Since the seller relinquishes ownership at the shipping point, the buyer must pay for the truck driver to make the delivery. The buyer will record shipping charges in the cost of merchandise, so it'll debit merchandise inventory and ultimately credit cash. Remember that this aligns with our cost principle. The buyer is ultimately recording merchandise inventory on the books at the amount it had to pay for it. Just as the discount taken reduces merchandise inventory to the final net cost, an additional charge like shipping and handling or sales tax will increase the value at which we record merchandise inventory. A sort of variation of FOB shipping point is prepaid freight. This scenario occurs when the buyer is responsible for paying for delivery, but the seller paid for delivery in advance for whatever reason. Consequently, the seller will pay for the delivery, and the buyer will repay the seller when it pays for the purchase. The seller will record a credit to cash for the amount dispersed to the delivery company, and debit AR for the amount to be repaid from the buyer. On the buyer's side, since the buyer is ultimately paying for delivery, it'll debit that cost into merchandise inventory and credit AP. Our key takeaway for the buyer is that it records the shipping transaction exactly as it did under our initial FOB shipping point scenario. We debit it into merchandise inventory. Also, please note how one company's account receivable is another company's account payable. Let's put these principles into practice. Imagine R&F sells $1,000 of merchandise on account that cost $500. Shipping and handling charges are $100 FOB destination. We'll book the first two journal entries as we've already done. Debit AR and credit sales for $1,000, and debit CGS and credit merchandise inventory for $500. How do we record the delivery charges? Under FOB destination, ownership doesn't transfer until it arrives at the destination. This means that R&F is responsible for paying for delivery. When the seller pays for delivery, it records it as an expense. So debit delivery expense and credit cash. How would the same transaction be recorded if the shipping terms were FOB shipping point? The first two entries wouldn't change at all. But how would we record the delivery charges if we are R&F bicycles? The answer is we don't. With FOB shipping point, the buyer is responsible for paying for delivery, so the seller doesn't have to do anything. Let's consider the same sale, but shipping terms are FOB shipping point, and R&F prepay the $100 delivery charge. The initial sales entries remain unchanged. Debit AR and credit sales for $1,000, then debit CGS and credit merchandise inventory for $500. Since we've already paid for shipping and handling, we've credited cash to the delivery company. And since the customer is going to repay us this amount when it pays for the purchase, we'll debit AR for that amount to be received. All that's left is to incorporate the early payment discount into the process. Consider the exact same entry, but with credit terms 210 net 30. Under the gross method, the initial sales entry doesn't change at all. I should probably note that you can combine the last entry with the first one. I generally advise against doing so, and that students should keep the two entries separate, just because it makes applying the discount to the cash payment much easier if you can track them separately. Let's consider the receipt of the cash payment both before and after the discount expires. If the customer pays within the discount period, we'll credit AR off the books and debit cash for what we receive as usual. Our total debit balance in AR for the sale and shipping owed is $1,100. So that's our credit to take AR off the books. Again, because this is within the first 10 days of our credit terms, we don't get the full $1,100 in cash. Only the $1,000 gross price is discounted by 2%. We then add the $100 of prepaid freight on top of that to get our total cash received of $1,080. The $20 debit needed to balance our entry goes to sales discounts. If the payment is received after the discount period, the amount owed equals the amount collected. So credit AR and debit cash for the full $1,100. That concludes this video on sales. Come back next time and I'll show you how to account for refunds. That topic is very simple, so I'll cover both the gross and net methods in a single video. Thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, please leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible. Thank you once again, and I'll see you in the next one.